Hello and welcome back to our monthly Global FX Outlook series. I'm George, the lead FX and macro strategist here at Canberra, and I'm joined by my colleague Antonio, our senior FX and macro strategist. And today we'll be walking you through our latest global currency outlook. So as we step into September, markets really are navigating a complex mix of political tension, shifting rate expectations, somewhat resilient risk appetite, despite the renewed turbulence that we've seen from the imposition of tariffs to legal challenges to Fed authority to political turmoil in Europe. Overall global assets have held their ground. Global stock indices hit all-time highs last month. The VIX Fear Index continues to trade comfortably below its long-term average, underscoring investor confidence. But before we dive into the key macro themes that are shaping global financial markets, particularly currency markets, we've got some standout moves from this report. Just to take note of, the US dollar, for example, was under pressure once again last month due to a dovish pivot by the Fed in the wake of the terrible US jobs report that we had, the US dollar index falling 2% in August. That marked its seventh monthly decline this year. And it only managed gains against just 12% of its global peers of a basket that we're tracking. Meanwhile, the euro rebounded, euro dollar clawing back over 80% of its July losses last month. And that comes despite the French political headwinds that resurfaced towards the back end of the month. We think a push towards 120 by year end or going into early 2026 hinges particularly on in the US. Here in the UK, sterling recovered more than 2% in August against the dollar, stabilized between 134 to 136 for the most part of the month. Supported by a string of strong UK data, hawkish Bank of England repricing following a tight vote split that we saw at its monetary policy decision earlier this month. But we have seen just this week that the 134 has broken to the downside, given the stress in the UK gilt market, with 30-year gilt yield rising to highs last seen in 1998. Down under, the Aussie dollar, trades around 2% above its year-to-date average, still in a tight trading range, but that kind of modest uplift has been helped by the broad US dollar softness that we've seen, and as I mentioned, elevated risk appetite. Plus, we've had some RBA rate cut expectations because of hotter than expected inflation data coming from Australia. So that's some of the key insights from the report, but let's jump into the main next. We're looking at the key global themes that we're keeping an eye on that are driving volatility and these trends in FX markets. Let's begin with the first theme then, that's quietly becoming one of the most consequential, I think, for global markets, and one that business owners should be watching closely, is Fed independence, because in recent weeks, concerns over the Fed's autonomy have started to escalate once more following President Trump's attempt to dismiss Governor Lisa Cook over fraud allegations. That move now faces legal challenges, but this unprecedented intervention has sparked a broader debate about its ability to operate free from political influence, especially with the rate decision looming from the Fed this September. Fed Chair Powell's dovish tone at the Jackson Hole Symposium was interpreted by markets as laying the groundwork for a rate cut, but arguably that's only intensified speculation that policy may be swaying under political pressure. And this matters because obviously the credibility is a cornerstone of global financial stability. And if that trust is eroded, then the consequences can be far-reaching. A weaker US dollar, for example, higher long-term borrowing costs, and increased volatility in both currency and bond markets. And we are already seeing signs of this. The US yield curve is steepening, driven mostly by rising long-end rates, not just from inflation concerns, but from the doubts about fiscal discipline and policy credibility. And this kind of backdrop is rarely supported for the US dollar, which is already down over 10% year to date. And this isn't just a one-off headline, it's an unfolding story with real implications. And this is going to be important for how businesses hedge risk, manage costs, and navigate global markets in the months ahead. The second theme stems from Europe. France's escalating political drama is beginning to ripple through markets once again. Investors increasingly pricing in heightened fiscal and policy risk. Prime Minister Francois Bayrou's austerity budget, featuring that 43.8 billion euros in cuts, and the controversial measures like scrapping public holidays has triggered a fierce opposition across the fragmented parliament, and that makes his defeat in the upcoming confidence vote highly probable. From a market lens, this isn't just about one prime minister, though. France is staring down the possibility of its fifth head of government in just under 2 years, a level of turnover not seen since the crisis years of the Third Republic. It does raise concerns over France's fiscal trajectory, of course, and reform credibility, and the potential snap elections injects fresh volatility into French assets, as we've seen French bond yield spreads widening against bonds, Eurozone risk premiums creeping higher, while sovereign spread correlations are usually typically weak. We have seen that the euro has come off slightly, and these rising tensions, especially amid the ongoing EU trade concessions to the US, could really undermine the bloc stance and weigh on the euro further. But this bond market turmoil isn't just confined to France, not at all. It's a global phenomenon, with long end yields rising across much of the developed world because of the concerns around excessive borrowing and debt sustainability, particularly the case in the UK, as I mentioned earlier, with gilt yields rising to highs last seen in 1998. So investors seem particularly concerned about what's going on in the UK and France right now, and that stress in bond markets is rippling across into the FX space as well. Now, the third theme is monetary policy, where the landscape is fragmenting, and that risks creating fresh volatility across the currency space. For example, in the US, the macro backdrop is sending mixed signals. On the one hand, we've got labour market softness is becoming hard to ignore, with the unemployment rate ticking higher, payroll growth slowing sharply. And then on the other, we've got tariff-driven inflation concerns, and that's complicating the Fed's rate path trajectory. As I said, Jerome Powell's speech at Jackson Hole did lean dovish, emphasizing downside risk to employment, but acknowledging that tariffs are pushing up prices. And he did stop short of committing to a cut, but his tone was widely interpreted as opening a door to easing. And as a result, markets are expecting, or pricing in, should I say, above an 80% probability of a 25 basis point cut this month. But it is far from a done deal. We think core inflation is still hovering above the 5% target. Some Fed officials remain cautious, but we've got some key data points to keep an eye on, because the Fed is data dependent, as we know. And the August jobs report due this Friday, September 5th, is integral. And then we've got the CPI inflation data on September the 11th, also critical in shaping the final decision. Meanwhile, the Bank of England, as I mentioned at the start, has adopted a moderately hawkish stance, cutting rates cautiously while warning that inflation risks, especially in services, remain elevated. That vote split of 5-4 at the last meeting signals growing resistance to further easing. And then finally, the European Central Bank, ECB, appears to be near the end of its easing cycle, having halved rates over the past year. A September pause here is expected, but further cuts may resume if growth falters amidst this US trade war, which hinders growth expectations. But ultimately, after months of distortion driven by tariff noise and political uncertainty, we think that currency markets are realigning with macro fundamentals. So, as monetary policy paths diverge, as we're stating, currency markets are once again becoming a mirror of this macro reality, bringing renewed focus to rate differentials, inflation and economic growth trends, and policy credibility. Now, before I hand over to Antonio for a deeper dive into the FX space and the latest FX forecasts, let's take a quick look at this month's risk events calendar. It's packed with market moving events, as you can see here. But top of the list, as I mentioned, is the US jobs report this Friday, September 5th. Expect some intense scrutiny of the back month revisions. Only 6% of the survey respondents typically reply within the first month, remember. So these revisions really can swing the narrative. Just last month, for example, that surprise downward revision sent the dollar 1% lower in a single session. So it really underscores how sensitive the markets are to the labour market data right now. As I said, the French confidence vote is on Monday, September the 8th. That could trigger a fresh bout of volatility in Eurozone assets. So keeping a close eye on that. US CPI, the inflation, lands on September the 11th. That's a critical piece of the puzzle. As I said, the Fed leaning more towards easing, as we've already mentioned, but any upside surprise in inflation prints could derail those rate cut expectations. And then comes a wave of global rate decisions from central banks. The ECB on September the 11th, likely to hold, as I said, but forward guidance is in focus here, is key. Week of September the 15th, this is the big one, decisions from the US, Canada, UK, Norway, and Japan. So a rare cluster that could reshape rate differentials and FX flows. And Switzerland and Sweden step up the week after, followed by Australia on September the 30th. So, why are we looking at this? Why does this matter? Because when markets are clouded by short-term noise, be it tariffs, political uncertainty, or geopolitical flare-ups, central bank decisions can often become the compass. They cut through some of the fog, offer something more tangible like interest rate paths, inflation targets, forward guidance. But as ever, clarity doesn't always mean calm. These decisions also carry the power to shock markets when expectations are misaligned. As an example, surprise hold from the Fed, although unlikely, but not off the table. It could send the dollar sharply higher if traders scrambled to reprice that risk. So in a world where monetary policy divergence seems to be back, surprises matter more than ever. So even a subtle shift in the tone or guidance is likely to have some ripple effects across global markets and cause some spikes in volatility, potentially driving some fresh trends going into the end of the year. But that's it from the economic outlook and the key events to watch for the coming month and coming into the rest of the year. Over to Antonio for a deeper dive into the FX analysis and FX forecast. Cheers, Antonio.
Thanks, George. Thanks for that useful insight as always. So let's kick things off with the FX volatility slide. Here we see sterling, US dollar just topping the chart, highly volatile in the month of August. Now, it's very interesting here. It was a play between dovish and hawkish expectations that ultimately pushed that volatility high. First half of the month, we saw narrowing rates, divergence following a more hawkish shift by the Bank of England, but also a more dovish turn from the Fed. The setup remains, however, quite fragile at its core. In fact, after we saw the pair rose in the first half of the month, it quickly sort of lost momentum as it became clear that the Bank of England's sensitivity to easing is ultimately lingering on the back of a soft macro data backdrop, but also those fiscal concerns over Starmer's government self-imposed fiscal rule, with those 30-year yields hitting 27-year high at the end of August, also playing a key role. The current setup, therefore, sort of erodes the credibility and stability of the UK government, but also raises chance of a further fiscal tightening to ease investors' concern. What would follow is slower growth, more aggressive easing, and ultimately a weaker pound. Now, onto euro dollar. The pair's volatility here was explained by two important factors: headline-driven risk premia tied to the US starting to sort of fail to grab investors' attention, or at least as much as it did back in April, as now investors crave something a bit more substantial to justify ultimately further USD sell-offs. But also dented euro sentiment, as George already touched on, following this renewed political turmoil in France and the Netherlands, as well as this sort of further and almost never-ending concessions that the EU is making to the US on the trade front, which is ultimately weakening the euro stance as dollar replacement over the summer. Now, finally, touching on USD CAD on the low volatility sort of side of this chart, the Canadian dollar's recent moves continue to be driven by a narrowing yield spread with the US, which fell below 100 basis points for the first time in nearly a year. Now, the shift has pressured the USD CAD below 138, highlighting year differentials as a dominant force for now explaining USD CAD price action. Having said that, the Canadian economy is starting to feel the bite from Trump's tariffs. In particular, August saw a 7.5 drop in exports in Canada's Q2 GDP data, which is the largest drop on record, which ultimately raises the possibility of a cut by the Bank of Canada, which will ultimately add pressure onto the loonie. Now, as we shift to the next slide, we look here at the value indicator chart. Now, here we remain bullish on the euro. Euro sentiment stays strong despite the just mentioned sort of dense in sentiment as the second most liquid currency that continues to benefit from this sort of ongoing dollar weakness. Euro dollar, in fact, tops the chart 4.7% higher today over the year-to-date average. Looking ahead, however, US macro data remains the primary driver here of dollar performance and euro in turn. Should September's labor market figures surprise to the upside, well, the dollar could see that short-term gains. And in that case, dollar sellers, may want to wait for euro dollar to reach more favorable levels before positioning ahead. When it comes to sterling, instead, we tend to lean a bit more bearish here, suggesting selling into what may be rallies or short-term rallies. Unlike the euro, sterling does not benefit from this sort of constant global flows away from the US when especially US sentiment is hurt. It faces a weaker fiscal position, softer economic data, and also a higher likelihood of rate cuts compared to the ECB. These factors ultimately point to limited upside for GBP, and any rebound may be short-lived, especially if US data surprises to the upside. USD JPY, USD CAD, and USD Mexican peso, they all sit below their year-to-date moving averages. Japan's relatively fragile political landscape, combined with rising global yield risk premia, could drive USD Japanese yen back above its year-to-date average. Meanwhile, CAD and Mexican peso remain heavily influenced by US macro performance and the evolving impact of tariffs on these export-driven economies. Should US data surprise to the upside, we see scope for short-term USD strength across these pairs. Finally, as we move on to the forecast section of our presentation, now here, instead of just trying to predict exact exchange rate levels, which is ultimately an inherently uncertain exercise, what we like to do is to focus on understanding key scenarios and the assumptions behind them. So if we take euro dollar, for example, our first pair here the central forecast, plus or minus one standard deviation from the baseline suggests a range of 113 to 119 over the next 8 months, with a 1.16 as baseline, implying a 68% probability the pair trades within the just mentioned band. Now, for the baseline to be met, we see trade agreements largely settled, although some nations will still contend with unexpectedly steep tariffs. Meanwhile, US economic growth slows down, although not aggressively or significantly, exerting mild pressure on the dollar. The Federal Reserve responds with measured easing, and as headline risks tied to trade and Fed policy continues to sort of get priced in, the scope of further dollar depreciation appears increasingly limited when it comes to the sentiment front. Now, as we look on to sterling USD, sterling US dollar, baseline here is 134 by end of 2026. Yes, the narrowing of rate spreads, as mentioned already, is likely to continue to support sterling, but we do not exclude an acceleration in easing by the Bank of England following tightening of fiscal policy as we approach 2026 to appease investors' concerns over fiscal pressures, which will ultimately weigh on sterling US dollar. On to USD CAD. Now we expect USD Canadian dollar to rise toward 140 by year end before retreating to 1.38 in early 2026. This forecast reflects a shift in Canada's earlier resilience driven by those narrowing rate differentials. On one side, the Federal Reserve remains uncertain about the extent of its easing cycle, while on the other, Canada's weakening macroeconomic backdrop as a result of tariffs may prompt additional rate cuts from the Bank of Canada. Now, with regional trade negotiations still unresolved, any escalation could further pressure the Canadian dollar. Last but not least, on to our next slide, the Australian dollar versus USD. Now, Australian dollar could strengthen against the greenback, hitting 0.68 by end of 2026 as the Reserve Bank of Australia, the RBA, pushes back against the global trend of monetary easing. However, while the RBA is expected to maintain its current stance in upcoming meetings, the interest rate differentials remains a headwind, as ultimately US rates are likely to stay higher than Australia's, which may limit ultimately upside potential for Aussie dollar, US dollar. And with that, I will pass it over to George to wrap things up. Thank you.
Thanks a lot, Antonio. Great stuff as usual. And as a reminder to everyone, if you want further details on other currencies and forecast scenarios, then you can obviously read our Global FX Outlook report, which contains that. You can access that on our Convera blog page, whereas you can also access all of our other macro and market research. And if you're interested to learn more around about our many solutions on offer, maybe you want more information on how to protect against currency volatility, or perhaps how we can help you diversify into alternative markets if your industry is exposed to supply chain risk, for example, or maybe you're interested in efficiency and security and want to talk to us about our automated global payment solutions, compliance controls, or fraud prevention measures. We've got a wealth of products and solutions that are related to both hedging and to payments. So please reach out to your point of contact at Convera to learn more. Thanks again, Antonio, for your insight today, and thanks everyone for listening. Best of luck. See you next time.